In this week's video, we'll review the latest technical and fundamental facts to help us answer the question, which path will the stock market take? We have a lot of information to cover this week. We will be moving rapidly. I would encourage you to use the pause button on your video player if you want to examine something in more detail. When the market is red, as it was on Wednesday, October 2nd, it's very easy from an emotional perspective to look for bearish analogs and bearish evidence. It's much harder from a discipline perspective to look for or try to answer the question, has the bullish case been negated? This is the U.S. unemployment rate. We've covered this chart several times in the past. This is the look that we want to avoid. This is the look that we want to avoid. This is the look of the S&P 500 on the bottom of your screen. These are the 6 boxes that you want to see checked if you are a stock market bear. Heading into Friday's monthly labor report, we said the data we had in hand said, for the most part, from a probability perspective, we really shouldn't expect to see an alarming jump in the unemployment rate. Now that the number has been released, where do we stand relative to checking the 6 boxes? If we added Friday's data to this chart, the answer is we can't even check the first box. How can we say that? If we add the new data to this chart, we would literally be off the bottom of the chart. The unemployment rate that was announced on Friday is 3.5%. which means on this chart, we would move below the lower Bollinger Band at 3.53. First box that we want to check is white space above the lower Bollinger Band. We don't have any white space above the lower Bollinger Band. We can't check box number 1, 2, 3, 4, 5, or 6. And price action in the S&P 500, does the present day look like this or this? The answer is no. Many of the charts that we cover in these weekly videos were incredibly helpful intra-week when the S&P 500 was down big. NYSE common stock only AD line. S&P 500 holds here. Look at the indicator. S&P 500 holds. Look at the indicator. We didn't see anything this week. This is as of Thursday's close. Obviously, this chart improved on Friday. There's nothing alarming on this chart here relative to signaling a run for the exits from the institutions. During Wednesday's session, we said the market gapped down and there was a decent probability at some point we would come back and try to test or fill this gap, which is exactly what happened during Friday's session. If you're a bull, that's good news. This tweet was out there during Friday's session for 48 minutes. 0 retweets. After the labor report came out, this is good news. The headlines: U.S. jobless rate fell to a 50-year low of 3.5%. If you were a bull or you were fully invested, this would be good news. 1 retweet in 60 minutes. Doesn't seem to align with investors that are fully invested, all in, or irrationally exuberant. Instead, it seems to align with investors that probably have more cash on hand than they're comfortable with during Friday's session. NASDAQ AD volume weekly. As of Thursday's close, there's nothing on this chart. The present day looks more like this constructive period here and really doesn't look anything like this concerning setup here. Reuters article that was published late Wednesday, early Thursday morning, so after the close on Wednesday, before the open on Thursday. Here's a quote in the article from a professional in the money management business. "I am more concerned at this point than I have been at any point in the entire year." Went on to say that the data that we had during the week was significant. We're seeing a real contraction in the manufacturing sector. Once again, these comments do not align with being fully invested, all in, or irrationally exuberant. They would align with larger than normal cash positions. This is the concerning data that came in on Tuesday. We took a hard look at that data in a short takes post dated October 1st. This is the concerning look of the present day data. This is the historical look. Something similar has happened 5 previous times going back to 1982. It seems concerning, but what do the facts say? If we look at the 5 other similar cases going back to 1982, S&P 500 for the most part did quite well, not as concerning as we might think. And if we isolate in on the 3 most similar cases, the S&P 500 did extremely well going forward. It's also fair to say if we look at this chart, the present day really looks most like this case. This is a very rapid plunge from blue to black. A very rapid plunge from blue to black. Historically, the most rapid plunges, really good things happen. That's the right side of your screen. We've covered 1995 for a long time. There's another interesting similarity between the 1995 case, where good things happened, and the present day case. This is an LA Times story dated June 29th, 1995. It's talking about the U.S.-Japan trade war. You can read these little blurbs here from the Los Angeles Times article dated 1995. It's interesting to note this trade war involved agriculture and manufacturing and tariffs. Sound familiar? You can make an argument. This is a sentiment gauge for the most part in the manufacturing industry. A trade war could cause sentiment to plunge rapidly. A trade war in the present day, you can make an argument, could cause sentiment to plunge rapidly. What happened in this case? 1 year later, S&P was up 26%. 2 years later, 60%. 3 years later, over 100%. 4 years later, 144. 5 years later, almost 160%. Simply telling us to keep an open mind about a wide range of outcomes, including much better than expected outcomes. Clients and regular viewers know this isn't the only thing that's similar between 1995 and 2019. You can pause your video player and look at this. A lot of similarities between a new Fed rate cutting cycle. July of 1995, right here when the S&P 500 was near a new all-time high. Just prior to that, a trade agreement was signed between the United States and Japan. If you're concerned about small sample sizes, you can pause your video player. If you watch these videos every week, you might have thought they're biased, they handpick the charts that they want to show us, and they only show us the good stuff. The chart on the left was forwarded to us intra-week as bearish evidence. This chart and this chart also forwarded to us via Twitter during the week as bearish evidence. You can find the charts and these little blurbs on our Twitter feed, but it really didn't take too long to look at these charts and basically say they really look like bullish setups. The present day looks very, very similar to 2005, 2011, 2012, and 2016. Once again, telling us to keep an open mind about a wide range of possible outcomes. To give you an example, the non-manufacturing index at very, very low levels here below this line. Very, very low levels below the line in 2012. After that, really good things happened in the stock market. Below the same line, about the same exact level, right as the stock market was about to make a major bottom in late 2015, early 2016. If you were on Twitter this week, or if you followed the ISM non-manufacturing report in the media, you might have come away with the impression that the report was an unmitigated disaster. It's very, very difficult to come away with that when you read this from ISM. A reading above 50% indicates the non-manufacturing sector is generally expanding. There are 4 major numbers in the report. And let's talk about why they have numbers. Numbers, much like the market model and the sub-trend strength model, these numbers allow them to take a lot of data. Some of it is good, some of it is bad. The numbers allow you to summarize it and really take your bias out of the equation. So really all we need to know is the numbers. There's really no commentary needed. The numbers encompass all of it. There's 4 numbers in this report, all 4 of them above 50. And the counter-argument might be, well, the trends, the rate of change, that matters. Of course it matters, but you can't assume and extrapolate that the rate of change is going to continually fall. You could have made the same argument here that the rate of change matters and the rate of change matters. Well, it didn't matter here because really good things happened, and it didn't matter here because really good things happened. Extrapolating in the markets is very, very dangerous, and extrapolating any of this data is very, very dangerous. Right now, what we know is this data does not look that bad. We'll see how the next report looks and take it from there. Day by day, week by week, month by month. Our Twitter feed this week was full of bearish evidence. What about this? What about this? This chart here was forwarded to us in this conversation via Twitter. Nothing wrong with this technical analysis here. Seems like solid work. You can see from a fractal perspective, we have some similarities between the look in 1987 with this break. And if we make the chart a little bit bigger, we can make an argument that this point here is similar to this point here. This point here would be Wednesday's session. Can't emphasize enough, there's nothing wrong with this chart. And if we thought there was something obviously wrong with it, we wouldn't be looking at it. But it's also noteworthy, there are some very, very, very significant differences between this point here and this point here. If we look backwards from this point here, and if we look backwards from this point here, the market here was extended significantly on a relative basis looking back 3 months. 1987, the gains were better by 5%, 6 months, 7%, 9 months, 7%. If we look back 1 year from this point and this point, significantly different, 34%, 1.5 years, 25%, 2 years looking backwards, this market is vulnerable and extended. It's outperforming this market by almost 60%, telling us that sentiment, allocations, there are countless things in the market that are different here relative to this point here. Credit spreads, covered this numerous times, will move quickly. Here's a reading that we covered June 5th of this year, 4.48%, which is quite a bit better than these concerning levels before the market took another leg down historically. Where do we stand in the present day? Better, worse, or about the same? The answer is a little bit better, or potentially about the same. Somewhat of a mixed bag. This level here is not particularly alarming. 4.4 really doesn't look anything like roughly 6% or 5.75%, which would be really concerning from a historical perspective. But we have seen spreads. Here's a little spike here. Credit spreads have been widening, telling us to keep an open mind about a wide range of outcomes. Nothing alarming here. This tells you that concern is quite a bit lower in the present day than it was in December of last year. But it is starting to rise. And as we've said numerous times, spreads can widen quickly. And this number here tells us to keep an open mind about things potentially getting worse in the weeks ahead. We make decisions based on the facts in hand. This is the fact right here. Not too bad. But this tells us it could get worse. We'll continue to take it day by day. As we know from past videos, the chase for yield typically ends from a common sense perspective. You're not going to chase yield if you believe the economy is about to weaken significantly and you believe that the probability of default on your bond, the one you're about to buy, is about to skyrocket. It's a chart that we've covered recently. Has anything really changed on this type of chart? Not really. Here are two major junk bond ETFs, JNK and HYG. Both of them still making a series of higher lows, and in both cases, the October 2018 high, in both cases, majorly in the rear view mirror. You can make an argument that's not the case for the S&P 500, and this is a form of a bullish divergence. NYSE Technical Index as of Thursday's close. This is the type of look that we want to embrace. This is the type of look that we want to avoid before really bad things happen in the stock market. This is the type of look this week that said try to be patient. We've covered this topic in the past, just another way to look at it. Tony Dwyer, here's the Twitter handle here. Major economy economic surprise index has ramped. This look here is typically bullish. A relevant point made via this Twitter handle here where my cursor is. It is an interesting phenomenon that bullish strategists who have been very right for a long time are treated with disrespect, while bearish pundits that have been wrong are treated like they have some special wisdom. Why is that? Well, the answer is relatively simple. We all have an intense desire to be right, and we all have a tendency to act in a way that will protect our ego in the short run. So relative to this tweet here, we often hear you're biased. Really doesn't make a lot of sense for us to be biased. Why is that? Because in the long run, maintaining a flexible, unbiased, and open mind is much better relative to protecting our ego than having short-sighted bias. Why is that? Because the best way to feel good in the long run is to stay properly aligned with the markets. The easiest way to feel bad in the long run is to get out of sync with the data and the markets. And this concept here is basically somewhat of a different way of stating this concept here. There's a big difference between looking for charts, data, and narratives that keep us properly aligned with the markets and looking for charts, data, and narratives that make us feel better. We've been doing this a long time. We've been in this situation here, and we've been in this situation here. We'll pretty much do anything we possibly can to avoid being back in this situation here. NASDAQ percent above their 200-day exponential moving average. Held here in 2012. Held here in 2016. These are the dicier looks here that we want to avoid. See this here? After that, really bad things happen in the stock market. Nothing magical about any of these charts. Just simply telling us here the present day as of Thursday's close still looked more like this constructive period in 2016 and looked more like these constructive periods in 2012 where the stock market held and good things happened. Here's a major low, a correction. A major low in the S&P 500, this is a correction. A major low in the S&P 500, so far these look like corrections. Everything that we just said about the previous chart applies to this chart here. A try to be patient look intra-week this week when really bad things were happening. Thus, going forward, The game plan remains the same. We're not assuming anything about what's going to happen next, good, bad, or indifferent. We'll continue to take it day by day based on the facts in hand. In July and in August, we noted that interest rates had been lower for a considerable period of time, and thus we should keep an open mind about economic data improving. Here's an example. This week, this headline appeared on CNBC. Reuters article dated September 30th. Third quarter could mark turning point in U.S. profit cycle. Strategist in the article, people are overestimating the negative from trade and underestimating the lagged response from a lot of policy easing. That's basically the exact same concept that we covered on July 26th and again on July 19th. And we have seen several examples of this concept in recent economic data. Similar theme here, right before the close on Friday. S&P 500 bullish percent index. Look, we want to embrace, after this point here, good things happen in the S&P 500. Look that we want to avoid early stages of a very uncomfortable period, early stages of an ugly period, early stages of a very ugly period. Favorable look here. After this, good things happened. Present day, unquestionably, during the entire week, looked more like the favorable, try to be patient periods relative to the we should be more concerned periods denoted by the red boxes. Fed Chairman at Jackson Hole was very, very market friendly. Fed Chairman, last press conference, very, very friendly remarks relative to the market. He spoke again on Friday, October 4th. Really didn't say anything to change any of that. There's always a lot of talk about how the Fed's run out of ammunition. Powell, September 18th. We are going to use the tools we have, and if it comes to it, we are going to use all of them. Powell, September 18th. We are prepared to be aggressive. Mr. Bernanke seems to agree. So does an opinion columnist from Bloomberg. Fed has no choice but to tackle both the repo market and a recession. Concerns in the repo market have not spilled over into the broader credit markets in an overly concerning way at this point. We'll continue to take it day by day. Long-term chart of the NASDAQ as of the close on Friday, October 4th. Market holds here in 2009, holds in the same basic area near a major low in 2016. We violate that trend here in 2018, but it seems as if this trend line, this point here, is becoming relevant again. We're back on trend. We held in the same basic area earlier this year and tried to make a stand this week. The NASDAQ, after all of the volatility this week, closed up 0.5% or up 42 points for the week. You can make an argument. This is consolidation with an upward bias. Consolidation with an upward bias. Consolidation with an upward bias. In this case, good things happened. In this case, good things happened, telling us to keep an open mind about better than expected outcomes. Global Dow, this still appears to be a massive long-term breakout that is holding. Gold versus the NASDAQ 100. We own both gold and tech stocks, as we've noted in the past, to add to our relatively modest stake in the yellow metal. We would like to see a little bit more on this chart here. That is to be determined. Did we see anything this week to make us change this assessment from last week's video? The answer is no. You can pause your video player to read these little blurbs from an opinion piece in the Wall Street Journal. It's extremely important that we respect that public opinion about any topic, including impeachment, can shift rapidly, requiring maximum flexibility about all topics, including this topic, and we must remain open to all outcomes. Thus far, these little blurbs here and these approval ratings here tell us not much has changed relative to this. Last week we said it might be a good sign that semiconductors had some white space in here heading into the China trade talks. As of the close on Friday, October 4th, this chart still looks good. In fact, during what was a very volatile week, the semiconductor ETF heading into the trade talks was up 2.11% for the week. Not much has really changed on this front. Friday, September 20th, we basically said we're moving sideways here. Until we get a clear resolution, we should have realistic expectations about a wide range of outcomes, including a bearish breakdown. Nothing's really changed relative to this point here and this point here. Here's the same chart as of the close on Friday, October 4th. Price is still above an upward sloping 50-week moving average, and we're still basically in this trend channel, telling us until we get a clear resolution, we have to have an open mind about all outcomes. If you looked at a weekly chart this week, you might have thought not much happened. Not really true. The S&P 500 closed Friday 97 points off the intra-week low. This moving average cluster here, this is a tight and flat moving average cluster. Price has recently moved below it and then back above it. This look here is telling us to keep an open mind about a big move in either direction. Right now, price remains above an upward sloping 200-day moving average. This look here with white space above the red 200-day is more constructive than this look here, more constructive than this look here, and the present day is significantly more constructive than this look here. This consolidation takes place below the moving average cluster that's rolling over and gets tight and is moving down. Today, we're above a flattish moving average cluster. Flat means indecisive, and until it's resolved, we have to keep an open mind. Common sense tells us from a mathematical perspective and trend perspective, when price moves sideways, as it's basically done for a very long period of time now, trend strength scores and momentum are vulnerable. When we look at the movement of the trend strength scores, a submodel of the master market model during the week, they tell us if we get a breakdown in this direction here, we will have no choice but to take it very, very seriously. And some type of incremental defensive action would most likely be warranted. We're not there yet. If you're a client, we lose nothing by maintaining an open mind about all outcomes. If the market deteriorates, it will allow us much more flexibility in terms of properly reacting and adjusting if needed. Nothing's really changed relative to this short takes post dated September 30th. You can Google this title here. This is the chart in the post dated September 30th. We're still, as of Friday's close, 111 points above an upward sloping 200-day moving average. Like everything else, we'll learn something either way. The fact that we didn't even touch the 200-day moving average intra-week this week during an extremely volatile week tells us that these concepts still apply. If you think about what we just said about this tight moving average cluster and this indecisive look here, logic would tell us that That makes a lot of sense in front of what could be extremely important trade talks between the U.S. and China. If something good happens, anything positive, if we can avoid a negative outcome, the market could move in this direction in a confident manner. Conversely, if these talks unravel and it's a negative event, all of these concepts here tell us we have to be emotionally, mentally, and for us, tactically prepared to potentially take action if price gets into this area here. Do we have anything that tells us to keep an open mind about better than expected outcomes, and anything else that tells us it was prudent to basically do nothing this week? Well, every single one of these charts that we've covered has said, yes, it's prudent to try to remain patient. What can we learn from the chart of growth stocks relative to the S&P 500? Remember, we were told that it's all over for growth stocks. Value is going to overtake growth. That may be the case, but this chart tells us it might not be time to give up on growth just yet, and we have not done that. 2017, the ratio makes a stand here and rallies. 2018, the ratio makes a stand here and rallies. We're trying to rally from basically the exact same area. This looks like a bullish breakout and now a successful retest of that breakout. Also noteworthy, this point here is right after the U.S. election. S&P 500 after this point here, really good things happened. This point here coincides with the low, a major low in December of 2018. After this point here, good things have happened in the stock market. The present day is similar to this point here and this point here until proven otherwise. That may be the case in the coming days and weeks, but right now, this is a bullish looking chart. Anything else that tells us people might be overly concerned about growth in the present day as they were here and as they were here? The answer is yes. This comes from Sentiment Trader. You can pause your video player and read the text here. Here's the Twitter handle. The key takeaway: this kind of apprehension from this group of traders has been a consistently good sign for stocks over the medium to long term. This is a form of sentiment. This is extreme bearish sentiment, which aligns with this bearish sentiment. Does it make any sense at all to believe that the present day might be similar to this major low in December of 2018? Yes, optimism in the AAII survey is at its lowest level since December of last year. The hard data that we have in hand is telling us to be patient, but to be prudently prepared for a wide range of outcomes. Therefore, we have to head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.